When I was in the process of buying my first home, I really wished someone had broken down for me exactly how much of a down payment I should aim for. Because if you're like myself, I was wondering, should I stretch myself to try and reach for a 20% down payment because that's going to save me money, or would a 5% down payment be enough? On top of that, what would be the best way to save for it? And unfortunately, at that point in time, there seemed to be a real lack of clear and straightforward information on the topic, and it just really all felt very overwhelming. And because of that, I'm determined to change that for you and as many others as I can. So today, we're diving deep into the numbers to better understand whether it is worth it to actually save for a few years so you can get that 20% down payment and avoid mortgage insurance, or if a smaller down payment would be more practical. Getting right into it, let's start off with the basics. How much should you really save? 5%, 10%, 20%, or maybe even more? There seems to be a magic number in all of this, and we'll get to the bottom of it through some detailed math. We'll also tackle where's the best place to save this money, because believe me, I was once confused about whether to stash my down payment savings in an RRSP, a TFSA, or just a regular high interest savings account. Additionally, we'll cover some of the tips on how to effectively save for that down payment, because I've seen many people struggle to just get the bare minimum of 5%. So let's lay down some ground rules first. In Canada, your minimum down payment is going to depend on two factors. Number one is going to be the purchase price, and number two is going to be whether or not your property is your primary residence. First, let's cover how the purchase price of your home impacts your down payment. So if your purchase price is $500,000 or less, then the minimum down payment is 5%. Now, if the purchase price is between $500,000 but under $1 million, then it's going to be 5% on the first $500,000 and 10% on the portion between $500,000 and $1 million. For example, on a $700,000 purchase, the minimum required down payment would be $45,000, as 5% of $500,000 is $25,000 plus 10% of the remaining $200,000, which gives us $20,000, giving us our total of $45,000. And lastly, on a purchase that is $1 million or more, it's going to be a minimum of 20%. That means if you were able to purchase a home for $999,999, essentially your down payment would be just very slightly under $75,000. However, if it was just $1 more and hit that $1 million price point, you would then be required to have 20% down, which would be $200,000. Now, in regards to the second piece of criteria, if you're planning to live in the home that you're buying, then you can put down as little as 5%, given it meets the purchase price criteria. A common misconception is the fact that this is a special deal which is only for first-time home buyers, which just isn't true. It's available to anybody buying a primary residence, regardless of if it's your first purchase or your 10th. However, if you're purchasing the property as an investment, or if the property is over $1 million, then you're gonna need to put down at least 20%. Another crucial point is understanding your budget. It's vital to know not just what the bank says you can afford, but what you can comfortably afford without overstretching yourself. This number or percentage of your net income is going to vary from person to person, but it's something you should determine before going out and looking. Now, onto the topic of whether to aim for a 5%, 10%, or a 20% down payment. While many people aim for 5% or 20%, there's actually a sweet spot at 10%. And here's why. Mortgage insurance costs decrease when you put down 10% instead of 5%, saving you a significant amount on your loan. However, if you're buying a home priced over $500,000, the math changes a bit. For the first $500,000 of your home's price, you can put down 5%, but for any amount above that, you're required to put down 10% as previously mentioned. But what about the pros and cons of putting down 20%? The biggest advantage is clearly avoiding mortgage insurance, which can save you tens of thousands of dollars. However, it's essential to weigh this against the potential of paying a higher interest rate and the fact that saving a larger down payment can delay your home purchase, in turn costing you more in the long run due to rising property values. This is especially important in the larger real estate markets in Canada, such as Greater Vancouver and the GTA, as historically, prices have risen faster than the majority of people can save. This also makes your goal number for saving a moving target, because let's say that you're aiming to save 10% of $500,000, which is $50,000 today. But in 2 years from now, that same property may cost $550,000, which means not only do you have to save an additional $5,000 more than you originally anticipated, but you also just lost out on $50,000 of appreciation. Not exactly ideal. If you're deciding between putting down 5%, 10%, or 20%, Consider your own financial situation, your plans for the future, and the current state of the housing market. Unfortunately, there is no one-size-fits-all answer, but with the right planning and advice, you can make the choice that's best for you. For those wondering where to save their down payment, keep it simple. If you're planning to buy within a year, a high-interest savings account is probably your best bet. Investing in the stock market can be too volatile for such a short time frame. And when it comes to saving strategies, consider setting aside extra income from side hustles or cutting back on expenses to boost your down payment fund. Additionally, the government recently introduced a new program known as the First Home Savings Account. This can be extremely helpful, especially if you aren't buying for a couple of years. Essentially, it allows you to take advantage of the benefits of both the income tax savings of an RSP and the investment tax savings of a TFSA. I have a previous video where I go super in depth on the topic, and you can check that out right here, and I'll also leave a link in the description if you want to finish this video first and then watch it after. At the end of the day, the right down payment size for you depends on a variety of factors, including your financial stability, investment strategy, and the housing market's condition. Whether you decide on a smaller down payment and invest the difference or go for the 20% to avoid mortgage insurance, the key is to make an informed decision that aligns with your long-term financial goals. If that's something you'd like to discuss in more detail based on your unique situation, or if you're considering buying in the near future, you can scroll down and click the first link in the description to book a call with me at a time that works best for you. Now that you've got a better idea on your down payment requirements, your next step on your home buying journey is to make sure you're aware of what the additional closing costs are. Because unfortunately, there's some additional costs that you need to save up for on top of your down payment, which not everybody is aware of. But the good news for you is that I've already filmed a video on that topic and you can check it out right here. Thanks so much for watching, and we'll see you in the next one.